I believe Bitcoin is legitimate. I'm not trying to say there's not misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency, debasing their currency by excess deficits, and some countries are. I believe we have countries where you're frightened of your everyday existence, and if you have an opportunity to invest in something that is outside your country's control, then you can have more financial control. And so I'm a major believer that there is a role for Bitcoin in portfolios.
Coming up today, stocks finished the day mixed but the week higher. What Goldman Sachs thinks will rally now. The lone dissenter. Jamie Dimon skeptical. Qualcomm tries to buy Intel. What's going on with China? Uranium rips up a Microsoft deal. And what exactly are they trying to hide from us? You don't want to miss this one, guys. Let's go. And welcome back, everybody. Hope you're doing well out there going into the weekend. Although it was a pretty flat finish for Wall Street here, there was a lot going on underneath the hood. Given that it was triple witching day, the expiry of options, index futures, and options on futures, all occurring at the same time, in tandem with a massive S&P 500 rebalancing, bringing in some huge volumes today. We actually got a little bit of a defensive rotation today, the opposite of yesterday's massive rotation into growth. However, that didn't change the market color at all, really. Pretty much looks exactly like yesterday's really bullish setup. Volatility, yields, and the dollar all downtrending. But we've still got a lot of breadth out there. There's a look at all 11 S&P sectors and their performance for the week. Coming out on top, discretionary, tech, and energy. Down the bottom, REITs, staples, and healthcare. So overall this week was a definite rotation back into the risk-on growth trade, even though that just pulled back a little bit in today's session. Looking at key assets performance this week, coming out on top, Bitcoin up 7.8%. Number 2, oil up 3%. Nasdaq up 2.4%, and small caps up 1.8%. Down the bottom, TLT bonds, REITs, and the dollar. All key US indices finished the day lower, with small caps the weakest, down off 1%. But like I said, Standard & Poor's did their rebalancing today, with a lot of that occurring in the tech sector. You can see monster volume there today on Apple. 318 million shares traded. Same deal with Microsoft, 55 million shares. And now officially we've got Palantir now added into the S&P 500 index. Also doing a whopping 450 million shares traded today. We're just going down to the 5-minute chart on these stocks. Almost half of that volume occurring right on the close. A lot of big funds rebalance on the closing auctions. It's where they can get a solid print, and specialists on the floor in New York can help arrange all that. Same deal with Dell, also officially added to the S&P 500 today. And stick with me today because I've got some interesting stuff for you, including gold ripping up once again to a brand new all-time high, almost $26.50 an ounce. However, once again, all across mainstream financial media, there's simply no mentions of it to be seen. So I'll show you a bit more on that later, along with some commentary from around the financial community on that. We're also going to talk a little bit today about uranium, having a really good day, up over 4% on the back of a deal with Microsoft and restarting the nuclear power plant at 3 Mile Island. And as always, I'm going to present to you a number of other relevant and interesting data and research coming out today. And just as a quick reminder, if you're into trading and investing and want to stay up to date on everything that's happening across financial market, then subscribe to this channel and these videos will show up in your feed. I've been doing this stuff for over 20 years. I used to work for an investment bank, and as my regular viewers know, I freely speak my mind. So you can be sure when you tune into Click Capital, you're going to get the real deal here. And once again, thanks to all my loyal viewers for hitting that like button and sharing your thoughts with me in the comments as well. I really do enjoy interacting with all you guys. But without any further ado, let's dive right in today. First, just following through on the monumental move we've had in markets this week, with the Fed starting its easing cycle with a 50 basis point cut, which I would call the softest cut of all time, given the data backdrop and where the stock market is. Now we've got Wall Street analysts raising their year-end target. BMO's got theirs at 6,100 now, signaling another 7% upside by year-end, saying the Fed's rate cut and favourable seasonal data support the bullish stand. They see broadening market gains and a likely soft landing for the US economy. And that's expected to benefit key areas that have been soft. For example, a lot of Americans have put off home renovations due to higher rates. However, now the likes of Home Depot and Lowe's could already be seen, the first of many likely benefits from the Fed's rate cut. Stock prices ticking up. Spending projects are expected to follow. Even Jerome Powell said on Wednesday, as rates come down, people will start to move more. With one research analyst saying home-related companies should soon see the beginnings of fundamental recovery exiting this year, and that Home Depot and Lowe's should keep grinding higher as all this comes together. And there's a look at the two stocks. Home Depot also getting a lot of volume today, trading up to multi-month highs, but still not taking out those highs from March. And same deal for Lowe's as well. Pretty similar look and picture there. But just looking at the retail sector as a whole, that's still consolidating, bouncing up and down like a kangaroo, but discretionary just took out those July highs. So market not really pricing in a pullback in consumer discretionary spending for the right here and now. According to Goldman Sachs, small caps just got the green light for a powerful catch-up rally, with them pointing to lower interest rates and a promising economic backdrop for small caps. Given the Russell 2000 still hasn't taken out all-time highs, been consolidating for a few years, interest rate cuts are seen as more beneficial for domestic American companies, along with a potential change in government. And it was interesting on Wednesday because for the first time in almost 20 years, not all Fed members were in agreement when they cast their final vote. We actually had a lone dissenter. Governor Michelle Bowman, who supported a smaller cut, says she worries that moving too fast looks like a premature declaration of victory, in which Jay Powell said, in his own words, he's not declaring victory on inflation. Actually said the economy's great, but inflation's not. That's why he needs to cut 50 basis points. Makes total sense, right? Or did he just bow to political pressure? Bowman, a Republican, was appointed to the Fed's board by the previous president in 2018. The former president of Kansas City Fed said because a Fed governor hasn't dissented in 19 years, certainly if a governor dissented at this stage, it'd be a big deal. Powell downplayed it and said that's fine. No single person has a veto, so it is just a question of who will vote for and against. Pretty much saying he doesn't really care if someone went against his opinion. And to speak in a Fed's wallah, he sees more rate cuts, inflation below 2%, and a strong economy ahead. In other words, the Fed is telling us they expect the softest of soft landing. And sounds to me they might be over-promising with the risk of under-delivering, maybe trying to put the markets and an economy on a little bit of a sugar high for the next few months. Really supportive language coming out all across the board. Janet Yellen still saying that rates at 4.75% are still restrictive. The Fed wants to get their rate down to a 2 handle within the next 2 years. At the same time, they see unemployment actually coming down. And like I said, if that were to actually happen, we may see the S&P 500 at 10,000. But of course, that is a big if. And so it could be changing the whole dynamic of what a 50 basis point cut means now. Before it's been associated with panic, emergency, the floor's fallen out from underneath us. Now the so-called recalibration has been described as a sign of confidence, not panic. However, the always skeptical Jamie Dimon, CEO of JP Morgan, says once again he's skeptical of a soft landing after the rate cut, saying he gives it lower odds than most people out there. He hopes it's true, but he's also more skeptical that inflation is going to go away so easily. Not because it hasn't come down, it has, and it can come down more. And in his book, they're preparing for a range of outcomes with interest rates anywhere from 2% to 8%, saying we may have gone from a lower rate, lower inflation, to a slightly higher rate, higher inflation, and that anything's possible down the road. One thing that is on his side and could give ammo to the bears here is the amount of media mentions of the term soft landing, now actually higher than the levels back in the early 2000s and 2007, when just like then the market was also hoping for a soft landing. Is this time different? Well, it is a little bit when you look at the 50 basis point cut the Fed did back then. Started 2001, September 2007, the market wasn't near all-time highs. It's a little bit off it. Just looking back in history, when the Fed does its first cut and the market's really close to all-time highs, within 2% of it, 75% of the time we're higher 3 and 6 months later, and a very impressive 100% of the time the market's higher a year later, on average 14%. And again, is this time different? What's interesting, looking at previous bull market, and here we are in the red, the amount of months down below, and we're currently approaching about the 2-year mark of this bull market when the S&P bottomed out in Q3 22. Looking back in history, over the next 6 or 9 months, a lot of these bull markets can either end or they consolidate and go sideways if they are to survive and keep going. At this point in a bull market, between the 2 and 3 year mark, quite a lot of choppiness and consolidation. And one of the reasons why I'm calling this probably the most softest cut in the history of the Federal Reserve ever is not only do we have S&P 500 earnings per share at all-time highs, the consensus forecast is for it to accelerate into next year in 26. And just like prior bear markets, this line really has to start turning down for the stock market to really get worried. We're getting towards the end of Q3, and what we get a few weeks after each quarter is the start of earnings season. Expectations for earnings growth in each sector still pretty healthy overall. Tech out the front, 15%, healthcare, communication services, utilities, with materials and energy still down the bottom given the recent falls in commodity prices this last quarter. But like we've all been paying attention to, it's really the jobs market, the US unemployment rate. Here in the light blue, inverted with the S&P versus the 10-year bond yield in the dark blue. Stocks versus bonds. You can see that correlation. When the unemployment rate goes up, stocks underperform. We've actually got a bit of a divergence right here. Stock market's been going up the last few months. Unemployment's been increasing. And this will probably converge at some point, either with unemployment going back down or the market coming down. Michael Cantro, the chief investment strategist at Piper Sandler, posted a poll on X today. I'm surveying institutional clients with the same question, seeing what X folks think. If the unemployment rate continues to rise, what level would trigger a sell-off in the S&P 500? It's been over 1,200 votes. 41% of people think if the unemployment rate went above 5%, we're currently at 4.2, that would trigger a big sell-off in the market. But over a quarter of people think 4.5, and a few people think 6 or 5.5. I would say somewhere around 4.7, 4.8. If we started creeping towards 5, the Fed's mandate, the market will sniff that 5 out before we actually get there, and we may take a bit of a correction in the market. But again, here's another data point to back up my theory of this being the softest cut. Looking back in history of where the unemployment rate typically is when the Fed does its first rate cut, not 50 basis points, just any rate cut, normally 25. Looking at the 20th to 80th percentiles, typically ranges around 4.3 up into about 6.5%, where the unemployment rate is already sitting when the Fed starts cutting, and that will typically rise into the easing cycle. Here we are at 4.2, below the 20th percentile. We got one research analyst, Barry Bannister, said high valuations and speculative investor behavior are a concern, and that there's a 12% correction looming for the stock market by year end. I think the S&P will be in the low 5,000 by Q4. Going on to say, just as countries that go rogue become almost uninvestable, investors caught in the grips of a speculative fever become almost unanalyzable, saying the stock market valuations are approaching a near 3-generation high, with the S&P PE around 24. Also got Bank of America saying the post-rate cut bubble risks mean investors should buy bonds and gold, as investors are once again exposed to the risks of a tech bubble inflating, and that bonds and golds are a good place to hedge that. And we are seeing signs of a bubble. One post on X that caught my eye today, what looks to be from a private investor, listing 6 popular stocks and their PEs. All of them above 100, and their stellar performances year to date. Eli Lilly up 60% year to date. Attached to that is a photo of him throwing out his Intelligent Investor book into the garbage. This is Warren Buffett's #1 book, in his opinion. He learnt from Benjamin Graham, in which he teaches disciplined value investing. Now I've got investors literally throwing that book out, saying value is dead. But again, one thing that is different between this time and last, got different risks out there as well, like the yen carry trade, interest rate differential between Japan and other developed economies quickly closing. Pretty much every developed central bank has already started their easing cycle or on the cusp of starting, and then we've got Japan having just started their hiking cycle, and we've got signs of inflation potentially bottoming out in Japan, now creeping back towards a 3 handle, and that's why they're hinting to the market they might have to raise rates again, could potentially set off another yen carry trade unwind. However, at the end of the day, that has nothing really to do with earnings per share of American companies. That's more just a deleveraging in the market's plumbing and a lot of hedge funds out there, which could still cause another VIX spike, an eventful day in the markets, but that too may prove to be another dip buying opportunity. Investors have been really looking if the biggest stock in the market are going to deliver on the hopes of getting back to growth. Apple, with the T-Mobile CEO saying the iPhone 16 is selling better than the iPhone 15, saying that it's nonsense. The iPhone 16 line's pre-order sales are underwhelming, and they're not only good but better than last year. And so that had been a bit of a building narrative that pre-orders for iPhone 16 were weak, China's weak, and I think that may have caused the price of Apple to kind of trade soft after they did the release. The market seems to be coming around to it, and in fact we're just a few points today off all-time highs. We're also starting to get a little M&A activity, which we haven't seen a whole lot of this last couple of years, with Intel popping up on reports of a takeover approach from Qualcomm. Now we know why Intel has been printing some fat green candles of late. Looks like word may have got out, and they may have already started buying over the last month. And this is why we do technical analysis. It gives us clues to what the big money's doing, as they really control the market and push around prices. Another big fat candle there today, although a lot of that probably is to do with triple witching and rebalancing. However, nonetheless, still well and truly outperformed the market today. Even though the Qs were down, Intel finished up 3.3%, catching a little bit after hours as I speak as well, with Qualcomm trading down 2.8%. That's what you typically see. When one company approaches the other, the acquirer will trade down and the takeover target will trade up. As a lot of hedge funds that engage in risk arbitrage, also known as merger arbitrage, they'll short the acquirer and long the acquiree until the deal is finalized. However, it can go on for months, sometimes years, and typically the target will trade at a discount compared to the takeover price. Unless the market thinks other bidders can come in, then sometimes it can trade at a premium to what the takeover price is. However, it doesn't seem we have a formal offer on the table right now. We're just getting news that Qualcomm has approached Intel about a takeover. But on the chart does look good signs of accumulation, like I've been noting over the last couple of weeks. Stock has been beaten down of late. And it's just funny, isn't it, seeing Intel, the previous dominant company in chips for decades, trading under 100 billion market cap. Nvidia, 30x of that. And speaking of which, Nvidia is still trading a little sideways as well for a few months now. Just moving on, we're getting a lot of negative reporting on the Chinese economy. Things over there aren't that great, still got a lot of problems in their property market. With this article here saying China has struggled to rebound from 3 punishing years of zero COVID policies during the pandemic, which prioritized health and security over growth. Economists expected that the pent-up demand released when those policies officially ended nearly 2 years ago would inject fresh momentum into the Chinese economy. That hasn't happened. And we definitely saw that in the States, that pent-up demand. As soon as people could get out again, they started traveling and spending, but not so much with China. Their really strict policies on COVID, among other things, has sent them into this multi-year lull. And just look at this chart of property prices in Chinese top cities. Been nosediving for 3 years now and pretty much giving them a lost decade of property growth. And that is a big deal for the Chinese because 62% of Chinese household wealth is in property, which is a lot higher than other developed nations. We even got India, which has been really hot this year and for a few years, just overtaking China in the world's biggest investable stock benchmark, the MSCI All Country Index, pretty much the world stock index. And that's because of the huge outperformance of India, especially since COVID. It's hard to believe the Chinese stock market, according to this chart, its returns are negative over the last 30 years. Is this gap going to go on forever? Or will the Chinese government eventually be able to get underneath their markets like they're trying really hard to do of late? And there's a look at FXI today. After that good rip up yesterday, in which it finished up over 3.5%, it too just traded a little flat there today, although on higher highs and higher lows. Moving on to the bond market, got yields up the front pretty flat after Wednesday, although long duration yields starting to pick back up, giving us a further bull steepening in the yield curve. There's a 2-year trading flat around 360, and there we are curling up on the 10-year, 374, and that's why we've got the 10-year, 2-year yield curve now climbing higher back into uninverted territory. And if it stays in uninverted territory and we don't get a recession in the next 12 months, well, that is unusual because most of the time that happens, we do get a recession within 12, 18 months at the latest, after the bond yield curve goes uninverted, which just going out to a monthly chart was a record length of time. However, was that manipulated by Janet Yellen, front-loading so much short-term debt? Also interesting to note, crude oil, one of the best performing markets this week. Maybe the oil market also recalibrating economic demand going forward, along with geopolitical tensions that just don't seem to go away and just seem to continually escalate, even though that's not the narrative we're getting from mainstream media. If you look at what's happening on the ground, it is true. And we just heard that again today from a channel I follow on X called US Civil Defense News, that's run by a retired military officer, former political advisor to NATO, and 3-star general, also an Iraq war veteran. He gave an update and said the Israeli Defense Force strikes Iranian facilities. Reports of massive explosion in an Iranian ballistic missile manufacturing facility in Tehran. The IDF has gone on the offensive with all their enemies across the Middle East. War isn't coming, war is here. The open source intelligence monitor says Hezbollah's command structure, as well as their communication network, has been effectively obliterated in less than a week after the Israelis infiltrated their supply chain, installed explosive devices and numerous products, pages, everything from air conditioning, walkie-talkies, set up a shell company in Europe, which Hezbollah then actually bought their devices straight off the Israelis, who then remotely detonated them, setting a whole new level of warfare. Never really seen anything like this before. And so once again, the Israelis pick off their enemy one by one. And we're still on the cusp of Ukraine being given permission by the US-led Western Alliance to use Western missiles to strike within Russia. In other words, this war could be going direct as well between the West and Russia, with them warning that if the European Union allows Ukraine to strike Russian territory with Western-supplied weapons, it will lead to nuclear war. So if we're faced with two scenarios, like Elon Musk says, and I know this is really controversial, there's strong arguments to be made on both sides, should Ukraine, at the direction of the West, concede some territory to Russia, along with them agreeing not to join NATO that was originally promised to Putin, along with NATO not expanding up along Russia's western border that was originally promised to him, and negotiate, or should we have a direct and potentially get into nuclear war and World War III? What does the West have to gain by doing that? Second option. Putin's already had decades-long grievances from seeing his big, powerful Soviet Union get cut down to size his entire life. Then he spent his time in power with NATO creeping up closer and closer and closer to Russia, making him feel insecure and threatened and causing him to bite back. And again, it's interesting the timing that this has been escalated right in front of the election. Maybe there's some people out there worried this could be negotiated away and the flow of weapons to Ukraine gets cut off. And maybe that's helping keep crude oil bid as well. $71 a barrel. Still on a short-term downtrend here, but if it were to come back, then that just sets up the picture for inflation to come back as well. But that's here and now what's going on with geopolitics. Long term, there's more other secular trends at play. A lot of the world is trying to switch over to clean energy, along with a resurgence in interest of getting back to nuclear energy. Regular viewers know I'm a nuclear uranium bull. In fact, my last stock pick for members was in the uranium mining sector that I just added to my portfolio, and that's how our portfolios managed to finish up today, even in a soft tape, because we got a nice rip up in the sector today thanks to news that there's plans to revive a nuclear reactor that had been shut down, and this is really rare. This is coming from Microsoft and Constellation Energy, who are going to revive a nuclear reactor at the 3 Mile Island in Pennsylvania. Constellation signed a 20-year agreement with Microsoft to help power the company's data centers. This is another trend we've been seeing. Big companies trying to partner closely with nuclear companies, even build their data centers right next to the reactors, feed power right into them as they use so much. And so this nuclear reactor was shut down in 1979 as a result of an accident. Actually a good documentary on Netflix, interested in that. And so these big companies not only need huge amounts of power for their data centers, they also have commitments to become carbon negative. We got one nuclear energy analyst saying, however big you think this Microsoft nuclear deal is, I am telling you it's bigger. One of the biggest power deals ever. $800 million a year for 20 years, $16 billion for one nuclear reactor from a 40-year-old reactor just to get to age 60. We now have a market for new build. And we've heard this story a few times this year actually, with Amazon pretty much doing the same thing, building a data center right next to a nuclear power plant that it can be powered from. We also heard Larry Ellison say that he needs some nuclear energy as well to power his growing need for data centers. So don't be surprised if we get a headline around the corner from Oracle doing the same thing. Even Japan's coming back to it after the Fukushima accident in 2011. Earthquake out in the ocean, sent a tsunami, causing a nuclear meltdown. Of course, they shouldn't have built a nuclear reactor right next to the ocean. However, all 9 candidates to be Japan's next prime minister have expressed support for nuclear power and what's said to be a pretty big turnaround. Again, this coming from a retired nuclear engineer. And there's a look at the most liquid traded uranium ETF in America, the Global X Uranium ETF, URA, popping up over 4% today, also catching a bit after hours. With it too, having potentially looked to have breached this downtrend line. And this is one sector that I am 100% committed to, and I'm only going to invest more and more into it going forward as I strongly believe in nuclear energy. And just moving on to one of the other best performing assets this week, Bitcoin. Got an interesting article on Forbes yesterday saying BlackRock reveals it's quietly preparing for a $35 trillion Federal Reserve dollar crisis with Bitcoin, predicted to spark a sudden price boom. They got concerns over growing US debt, and this is a pretty big call for a mainstream media outlet like Forbes to come out with some text like fears swirl, the US dollar is on the verge of a total collapse. I mean, that's a pretty big, bold claim. It's not one I'd really agree with for the here and now, but they go on to say there's growing concerns in the US and abroad over the state of US federal deficits, and debt has increased the appeal of potential alternative reserve assets as a potential hedge against possible future events affecting the US dollar. And that is true. That's why gold and Bitcoin kind of exist in the first place, but they've also been catching a bid thanks to the reckless spending and blowing out of debt, especially by the current US government. And even though it hasn't done much to devalue the US dollar, even over the last 3.5 years, it's actually risen. This is more of a medium long-term problem for the dollar and its potential devaluation that comes from reckless government spending. And it's interesting to see the world's largest asset manager, Blackrock, actually get behind Bitcoin, with the SEC just approving options on BlackRock's Bitcoin ETF. And so it's kind of hard to know what to make of all this, isn't it? BlackRock's supposed to be part of the establishment. A lot of people call them the most evil company in the world because they have so much sway and influence over companies, being the largest shareholder in them. But they're a passive holder. They don't push for any activist kind of things to happen at the company. They do have some ESG mandates. They've been able to affect the world like that. However, what exactly are they trying to do in Bitcoin and speaking against the US dollar? What's the play there? Are they really trying to separate themselves from the US government, become kind of a global company that doesn't really care what happens to the US dollar, and they're hedging their own bets because they see there are big risks with the US dollar? How much influence do they have over government policy towards crypto? What's the world going to look like if Bitcoin does go to $1 million? What about $10 million a coin? What's that going to do to things? And there's a look at the digital gold today. Trading above $63,000 a coin, definitely catching a bid since J-Power Wednesday. Just like gold is, obviously, as well. Trading really firm here today. Again, ripping up 1.2% on volume, which is a big move for the normally low volatile asset of gold. And just like gold permabull Peter Schiff said today, gold is up over $540 so far this year, the largest dollar gain in history. The fact it's happening in a year with soaring national debt and the Fed cutting already low interest rates, despite inflation being well above its 2% target and heading higher, is not a coincidence. And the other strange thing, like I said at the start of this video, something I've been noticing the last couple of weeks, and it's not a conspiracy of mine, there's actually data to back this up, is mainstream financial media are just not reporting on it. Here's the front page of the journal today. Scrolling down, nothing about gold. Said stocks slip after post-Fed rally, but again, nothing about gold, even in their markets and finance section as well. Scrolling down, nothing about gold. Again on Barron, Dow ends a strong week with another record close. Intel, Nvidia, always going to see articles like this, but again, nothing about the shiny stuff? What are they trying to hide from us? Once again, Markets Insider. Nothing to be said about gold breaking out to a brand new all-time high. Scrolling down. Once again, there's a focus elsewhere. The popular Market Watch website. Intel, Fed, Jamie Dimon, baseball, electric vehicles. Nothing about gold. CNBC, Qualcomm, rates. Once again, same old stories. No headlines of gold. Or could they have instructions, keep this story under wraps from the masses? Of course, all of us in finance, we're watching this stuff every day. And that's why you come to Click Capital, because I've got nothing to hide. I don't have an elitist agenda. I freely speak my mind, as I'm always trying to get you guys closer to the truth and what's really happening out there. Because it could be like this former hedge fund manager said on X today, a system that relies on exponentially increasing levels of debt for each incremental unit of productivity eventually becomes so unstable that it simply collapses under the weight of its own leverage. Shown here in the red line, the exponential increase in US debt and then US GDP. And trust me, I'm not rooting for this to happen. I don't want the US dollar to explode. I think that's really bad for the West. Opens up a lot of security risks. I want this to reverse. It has to reverse. It's simply unsustainable. And the more people that call it out and push back on it and vote accordingly, then hopefully this can come down and the US dollar doesn't fall off a cliff. However, as investors, we've always got to protect our wealth first and foremost. And that's why I've been diversifying my wealth out of USD assets. Still my largest allocation, but I've been bringing that down over the last couple of months. As I, like many others, are a little bit worried about the future and especially what's just around the corner. However, I did find an article on the National, little known publication. Gold hits a new high this week as weak dollar and Middle East tension boost its appeal. And I guess this is the two things the establishment doesn't want really printed in headlines, does it? Weak dollar, Middle East tensions. At a time when Americans are about to go to the polls, cast their votes, who they want to lead them for the next 4 years. And like I've been saying, in gold's eyes, the US dollar's been getting decimated, especially the last couple of months. And even though gold is normally a sleepy, low volatile asset, it can rip like crazy if it wants to. Look at the price action we got in the late 70s, 1977, 78, 79, coincided with inflation that just like back then the Fed thought they had under control. They loosened conditions again. Gold shot up from $150 an ounce to $850 an ounce in 2.5 years. So imagine seeing gold at $10,000 an ounce by 2027. But just like gold and pretty much every other commodity out there, there's not just the devaluing US dollar as part of the bullish thesis. It's not just geopolitics, the worst we've ever seen. It's also been that huge underinvestment over the last decade and a half. Due to low commodity prices, it just simply wasn't worth to invest. There was no ROI. Along with the rising cost to find new discoveries, and this chart of major copper discoveries illustrates that point perfectly. It's well down from the 1990s, and that just sets up for supply deficits going forward, along with increased demand that's going to squeeze the prices of commodities higher. Add on top of that a weak US dollar, and that could just set the stage for a massive secular bull market in commodities, especially when the world's biggest consumer of them, China, eventually gets back to economic expansion, which is just a matter of time. And you can pretty much bet your bottom dollar that we'll see quantitative easing 5.0 soon as there's the next little hiccup in the economy or markets. Jay Powell fire up the old printer and flood them once again. The dude's worth $100 million. He's going to keep him and his buddies rich all the way to the end and let the rest of us deal with it when they're all long gone. Again, just weakens the dollar by creating so much of it. And so there we are, guys. Gone a little bit into OT today. There was a lot to get through. And like I said, even though it looked like bit of an uneventful day here on the daily chart of SPY. There was a few things going on underneath the hood. Breadth is still holding up. Volatility at 16. TLT pulled back right after J cut. High yield bonds still sitting pretty. And there's a look at the dollar. Still sitting at the bottom of the support range 100. Did look to be some potential signs of accumulation there. Wouldn't be surprised if we do get a bounce and a bit of a shakeout. However, the fundamentals simply don't look good for it. For the here and now, in the medium term, this big giant ship has been going in the wrong direction for a while. It's going to take a lot to turn it around. Also got silver starting to tick up as well. Also interesting today, big rip in utilities. Big volume, hitting highs. Second best performing sector, gold miners, with actually home builders and semis coming off a bit today. So we've got a bit more work to do on semis there. Otherwise, that's a wrap for this week, guys. Thanks very much for sticking with Click Capital. We've got some PMIs coming next week, bunch of Fed speakers, and we'll see if the S&P can defend these all-time highs above 5,700, or was this indeed a little bit of a fake out. Have a great weekend, and I'll see you again Monday night. Cheers.